what's up, everybody? Welcome aboard. It is, I don't know, Trading with Bubba, whatever we call my show here, but welcome aboard. It's great to be with you. And markets are getting waxed. Is this the sign that it's over? Notice as you're looking at the chart here. Oh, I'm not showing you the chart. I'm going to show you right now because I will remember to do that. You guys know I'm a little slow when it comes to that. I wanted to put a different screen up here. So hold on 1 second here. Let's see. I want to present, and I want to share a screen. Hold on, guys. I'm with you. I'm gaining speed. I got to get used to all the new controls because it's such a fancy setup here. So you can see, and we're breaking down through support right now. Okay. In fact, yesterday's rally was rather predictable, and we were looking for what might have been some pretty key action after the end of last week. The markets looked very ugly and actually had a key reversal on Friday. Okay, open on their highs, close on their lows. And yesterday they bounced naturally off support. Now this morning we're breaking down. So now the markets are in real jeopardy of breaking down. Now again, we're not going to tell you that it's time that they're going to zero, that they're going way lower. Now is the time to kind of watch how they react around this area and a close below support. Remember, we're only an hour and a half into the trading day today. So this is really not near a final score. We are watching with very close eye as to where we go and what we're going to do from this particular point here. Now, if we break and stay below, then it's certainly a reason to look, because what will happen is the big line that's across the middle, that's right here. If this does hold below, then this will now become resistance. Right now, it's still support. And as I say, it's only barely below right now. And of course, what we have to remember in the world of trading is that we're not trading with a scalpel. We're trading with a butcher knife. So we're using areas. So we're in very interesting action here in the S&P. In the NASDAQ, same thing. You're below. So now we can see that the NASDAQ has probably turned over and is headed a little bit lower. Now, again, how much lower? We don't have an idea right now. But right now, our next target would be down, let's say, 15,000. So still 200 points away. But I'd be using this 15,500 or so as a potential spot to sell, get short against the Qs or whatever. Depending on what you're trading. I mean, I'm trading everything. I'm trading futures. I'm trading options. I trade securities, so it doesn't really matter. The Russell is coming down to a key support. And again, this would be another area you'd look at the Russell. So basically, everything but the Dow is now breaking down. Okay. So when you look at it, when the Dow breaks down, okay, or when the rest of the markets break down and the Dow doesn't, that is actually very bearish. The Dow is an index that is going to perform better in a crappy market, okay? Because that is still, believe it or not, it is still considered the safety play among markets. People still run to the Dow. There's a lot of dividend-paying stocks in there. And if you go back to the closest reference point we can go to, in 2008, as we look at the Dow futures right now, they're trading at, let's say, 35,124. So if you multiply that by $5, which is the tick size, it gives you a contract that's worth, let's say, $176,000 if it goes to zero. Okay, the S&P trading at 44.8. Okay, which you multiply by 50 gives you an index that's worth about 230,000. Right, so there's about a $50,000 premium from the S&P to the Dow. In 2008, before the markets collapsed, the premium was about 25,000, and by the time the market bottomed, they had actually inverted, and the Dow was worth more than the S&P. So as we look at the other way, so we expect that if it does break, now listen, I'm not telling you that they're going to invert again. But I will tell you that this is a very bearish setup as we look at the markets. Now we're not predicting. The trend itself is still higher right now. As much as I'd like to tell you it's time to get short, it's time to watch very closely. And the key when you're trading is understanding the positioning and the condition of the market that you're in, and how to go ahead and make the best particular trade for that market. And, as we're looking, so I'd be looking at maybe, different securities, like I would look at Apple. Okay. Well, would I want to short Apple here using puts, or would I want to do anything? Oops, sorry. I've got it. Let me remember to put it on. I got it. I got guys watching me because they don't trust what I might say. I might have to get beeped about 500 times. Anyways, they're actually watching out my back because I forget to do things. I start talking and forget. But anyways, would I want to short Apple here? And no, I don't want to short Apple here. I am short Apple myself, full disclosure, but I'm not going to enter a new short here. I would be waiting for a rally to want to sell into. So that's not in the cards right now. Okay. Another short that I might be holding right now, or that I am holding, okay, is Tesla. Okay. Now, am I going to want to short Tesla? No. Remember, I don't ever want to put on positions that are converse the market if they're at a spot of support or at resistance, depending on which side I'm going to. I want to make sure, like I do want to sell Tesla again, but I want to sell it into a rally, not into a fall. Okay. Again, I don't ever want to chase, and we don't ever want to chase the markets lower or higher. We don't want to be part of the FOMO crowd. We want to be part of the crowd that understands what we're trying to do and what we're trying to accomplish within this market, within the structure of where it's at. So, as we look at different vehicles and different stocks, now these are the reason I'm showing the ones here now are ones that actually I cover every Monday night on my live webinar. They're ones that I talk about all the time. So these are already kind of marked up. Okay. Now, Amazon, for example, if I was looking and was inclined to buy, I'd be looking to buy Amazon and put a position on. So now what kind of positions do you use when you start to trade? Okay. Well, depending on what you're using, for obviously in equities, you can either buy the equity, you can buy, if you want to get long, you can buy a call, which I never recommend. You can create a position, which is what I do recommend. And when I create a position that is using the derivatives, in this case, it would be options on the stock of Amazon. So what would be the trade that I would want to set up here? Well, I can create a synthetic stock if I want by simply I can buy the call, sell the put. Okay, if I want to get long. Okay, so I use the at the money, I use the 139. So I'm going to create a synthetic. Okay, and collar synthetic combo. Now I need to cut the margin down because this trade here, this is a true what they call risk reversal. Okay, which is what a lot of floor traders use, which I use on the floor a lot because we didn't have the same margin requirements. But as a retail trader, we have margin requirements. So I'm going to have to add a put here to cover up my margin. God dang it. Okay, so now I've got a representation of the stock. So what I'm really doing here is I'm buying the 139 call, okay, for $1.13. If you're going to buy the 139 call, you're going to pay $2.99 if you buy it naked. Okay, I'm buying that same call for $1.09. So which is a better position if that's a trade I'm going to make? Okay, well, the better position is obviously mine because I'm paying $2 less than you are for the same trade. Now there is one difference. My trade, I have a little bit more risk if I'm wrong, but again, I'm banking on the upside that I'm right, so I can go ahead and create this trade. Okay. While you have $2 more to overcome of movement before you can make money, whereas I have only $1 to have to overcome to make a lot of money. So you understand what I'm saying? And I know there's, I'm throwing in a lot of stuff, and it's kind of like you're just watching me the design things live that maybe you're not familiar with. So whatever I show you, keep them in mind, and you can ask questions at any time you want. Okay, as we're going through this, and I'll go back and answer them. But that's the kind of trade that I'm going to do, is I'm going to go ahead and create something different. Now, let's just say we're getting something, and I forgot what I was going to look at last night, but there was some stuff that made some pretty big movement yesterday that I wasn't paying attention to, but let me just see if I can locate what I was at, because actually I do know one right now. Hold on, let me go back to this. Okay. XBI got creamed on yesterday, and I said to my member last night, it would be one I would consider buying. And sure enough, this is probably a buy point. Okay. So what I would do here, though, and again, here's a different trade. Now I'm playing a trade off of what we call a blow-off pattern, right? The blow-off is a straight buy or sell-off on heavy volume. Okay, look at the volume. It's the heaviest volume it's had in months. Okay. And we went straight down. As it turns out, in this case, it actually went straight down to support. But that is not really part of this trade. So what would I do here now? Well, so now I would go back, okay, to my options trades, okay, and I would look at XBI, X-ray Bravo India, okay, and so now I would look at this trade. Now I would first look at the 11th because I want to make a very short-term trade. So I want to figure, well, I think we're going to get a rally. So what kind of trade do I want to put here? So in here, I would be looking at selling a put spread, okay? And what I want to do is I want to sell a deep in the money put. So let's say I want to sell the 83 put, okay? That's pretty deep in the money. And I want to buy the 79 call, okay? So now I'm putting on a $4 spread for 81 cents, okay? It's the credit I'm going to collect is $3.19. So it's a $4 spread minus $3.19. So I'm putting this on for 89 cents. Okay, it's costing me, and this is the equivalent of buying the 78 call. Excuse me, I apologize. The 79 call for $1.18. So once again, I'm paying less to buy the same thing that you might buy if you wanted to take a chance to the bullish side. Now, what is the issue here? What am I giving up to do that, right? If I'm doing something, I'm giving up something. And the first trade I showed you, which was the synthetic risk reversal, I was giving up a little bit more risk. Okay, I had $5 risk where you had $3. Okay, but I'm assuming that I'm going to be right, and I want the benefit of collecting faster. Here, what I'm giving up is if it goes past 82 or 83, I stop making money. I can only make $3 on this trade the way I have it set here. Whereas if you buy just the call, you can make more. But you have to think yourself, because options trading is a probability model to begin with, you have to think to yourself, what's the probability of going past 83 in the next 3 days? Okay. And if I think it can really happen, then certainly I can sell a deeper in the money put and open up even more possible profit. Okay. So now I can do the 85, which puts me in a $6 spread for $5.13. And of course, why wouldn't I do that? In fact, I'm going to go do that in my Tradier Trade Hawk platform, this one, okay, that I'm actually trade off of. Okay, and I'm going to do it right now. While we're here live, why not make a trade if I can't? I'm going to do a 10 lot. Hold on. Let's see. I'm going to do XBI. And I'm going to sell the 85 put. 1, 2, 3, 4, 5, 6, 7, 10. And I want to buy the 79 put. Okay. And it's rising 10. Okay, bang. And let's enter the order. Okay, now my order is working. Let's see if it gets filled. I won't adjust it right now. So again, the beautiful thing about the world of options is you get to create. There are so many different creations that you can make, and it really is what the story is what are your objectives? What is your risk tolerance? What is your true expectation? Okay, that's what you have to focus on. Are those details, okay, when you're watching and when you're putting on and deciding to put on a trade? Because when you do that, you then create the best possible trade at that time. Now, again, listen, we know that there's never a guarantee that's going to be a winning trade. But your biggest job is that you have to create a defensive mechanism, or basically a built-in mechanism to take off the pressure from you having to make a bad decision, to take off an emotional decision that you can be forced to put yourself into when things can go possibly wrong. Okay. And again, I know that you can't communicate with me. I can't say, as I'm doing live calls, which is live, but I don't know everybody here, but you guys say, does that make sense? because again, my job is to make sure that I educate you so that you're in the best position as a trader going forward, right? So we want to make sure that we have liquidity. We want to make sure that we're understanding the trade that we're trying to put on. And one of the trades that I like to do the most these days. Oh, hold on. You switched me ahead of time? Okay, right? Okay, there we go. One of the big trades I like to do right now is I've been using a lot of double calendars and double diagonals because the volatility has been so low. And one of the things you want to remember is low volatility is usually a better opportunity for you to sell because that means that it's falling. Remember, if you understand what implied volatility is, okay? Implied volatility is forecasting what's going to happen in the future, okay? And too many people make too many mistakes when it comes to what IV is, and we have to understand that IV, implied volatility, is simply what the markets are deciding or telling us they're going to do in the future, which is no guarantee, but it does give you an idea of price movement. So, for example, I happen to know that Zoom has earnings coming soon. So when I look at the Zoom chart, their volatility today for this week is 54%. For next week is 49%. And then the following week, it jumps to 74%. So I know something is going on the week of August 25th. Okay. So what could possibly be going on in the stock of Zoom on August 25th or that week? Well, I don't know. I do know, but you may not know. So what do? Well, you investigate it. So the first thing you would do is you'd go to the chart and look at a chart and say, okay, what is going on that date? And there's an earnings bubble here, which is 8/21. So that is the week of 8/25. So I know there's earnings. So I know that volatility is expanding because of earnings. Okay. So what do I want to do with that? How do I want to try to take advantage of that? Well, there's different ways to work on that. But the first thing I have to understand is that the expectation of movement into that period is now about almost $9, okay, of a stock that is $65. So the expected move is about 14%, okay? Well, we know that trying to buy premium at a stock that normally trades at a 40% volatility or 45% volatility that is trading at a 75% volatility, we're not going to make any money if we're buying premium in that week. What you have going on here is you have a lot of premium buyers that are trying to take shots, buying straddles, buying strangles, buying calls, buying puts, all going to be losers, especially if the stock doesn't make the move. So how do you gauge where the move's coming from? Well, you look at the at-the-money straddle, okay? And you say, well, so if I buy the at-the-money straddle for $8, that means that stock's got to move $8 one way or the other for me, what? Just to be even. Okay, is that what you're looking for? Even? And if it doesn't move $8 one way or the other, guess what? I'm going to get killed. I'm going to lose a lot of money. So what do? Well, we create a trade around here. If we have a particular lean on the stock, well, we might do, for example, we might buy a diagonal, okay, or a weighted diagonal. But let's say we might buy a diagonal, right? Okay, let's see here. I don't want double. I just want a regular diagonal. There we go. I might buy a diagonal, which would mean I would sell I would buy the 67, but I want to do this backwards. Okay, I want to make this custom. I want to buy an extra one. So I'm going to actually do a ratio diagonal, okay, where I'm long 2 calls and short 1. And not only am I short 1 for the week of the 25th, but actually if I want to put it on, I can start today and I can sell 1 for the week of the 11th. Okay, so now I can sell a call for the 11th. And then, of course, once that fills, then I can buy that call back in a day or two and sell 1 for the 18th. And then I can buy that one back and then sell 1 for the 25th. So I can sell 1 call 3 potential times between now and that expiration. Okay. And then I've got 2 long calls, which are at a less amount of premium. And if the stock goes my way, I can make a ton. If it doesn't go my way, well, how much premium have I collected going up to there? And right now I would collect, if everything went perfect, and again, obviously we don't know things are going to go perfect, but let's say I collected $1.33, I collected 207, okay, and I'll collect, let's say 415, okay. Now I won't get all those because obviously they'll change as we get closer, but just in theory, and of course I'm paying, okay, for the call that I'm buying. I am paying September 1st. I am paying 450 times 2. So I'm paying $9. So I can see mathematically if I can do everything exactly as it sits here and sell these calls each and every week, then by the time I get to the expiration, I've collected enough premium to finance the entire call that I've bought. And now I'm basically free rolling on at least 1 call, possibly 2. Because depending on how everything breaks, okay, anything can happen, and I can end up collecting enough premium to pay for those 2 calls that I bought, and I can go the last week with no risk and own 2 long calls. That either I can sell one, take some profit, hold them both and go for the gusto, or sell them both and take the profit and walk away. Okay. Now I know it's a mouthful, and again, these are things that we're just discussing as we look into different parts of the world of trading. Okay, this is things that you may not know, maybe you know. Okay, if you do know them, then let's know them better. Okay, let's make ourselves better. Okay, now I didn't get fill on my XBI, but I'm going to make myself just because I'm with live. I got to make sure I get filled. Okay, I can never go without at least getting filled with when I'm trading live. I got to make sure I get a fill. Okay, I am filled now. Okay, I have a 92-cent risk. Okay, on a trade, which we'll track it until it's over. So I'll track it for the next couple of weeks and see what happens. Now I've only done it for this week for now, so I'll fill you in on Thursday or whatever. But in the meantime, again, so basically, first what we're doing is we're watching or taking a look at our list of things that we're doing. Okay. And what are we doing? What are we looking for? Well, again, we're looking for movement. We're looking for price action. We're looking to determine. We're not trying to use our opinion. Okay. What we're trying to do is we're trying to locate opportunity in a market of either a watch list that we have, okay, which is here, this list here that you see. I carry positions for right now, for example, short Apple, long Amazon, long coin, Meta, I don't care position, long Google, long gold, long IWM, short Microsoft, long Qs, short Square, long SPY, short Tesla, long Win, and long XLE. Those are my open positions in addition to everything else I trade. Okay, so these I cover each and every week. These I cover all the time because these are liquid. And one of the things that I think is very important if you're going to trade options is to use the weekly options, okay, or use the new daily options, or they call them 0 DTEs in the SPY. Why? Because again, you're getting more opportunity. Okay, the more you can sell premium against what you own, and I do not advocate ever selling negative premium. Okay, because I think that the exposure and the risk and the margin requirements are way too high for the average person. Okay, I advocate creating a trade around it. Okay, and I think that it's important for you to understand, when you can set up positions, when you can set up a trade and take your emotion out of that trade as well, or the fear of losing money by knowing exactly what your risk is the minute you put that trade on, wouldn't that make you feel better? Okay, wouldn't that put you in a better mental position? Okay, that's what you have to think about, right? Because again, not only is trading about the trade itself and finding the trade, but trading is about taking care of this part, right? Because the worst enemy of any trader is the person here. Okay, the guy or gal you look in the mirror, that's your worst enemy. Okay, that'll be the one that will force you to make bad decisions. And if you're making bad decisions, then you're costing yourself money. Okay, because we know to begin with, not every trade is going to be a winning trade. Okay, not every trade is going to hit the home run. Okay, you have to learn in this business how to grind. You have to learn in this business how to set yourself up and put every part into your advantage, and know that even if you're at the advantage, that you still may lose. Right? Pocket aces, if you're a poker player, lose. I lost a backgammon game one time for $5,000. The guy had to roll double sixes 3 times in a row. You know what the probability of that is? It's 36 times 36 times 36 that he did, and he did it. Okay. Hey, it's going to happen. So the first thing you got to make sure, though, is you are in a mathematical high probability position, because even then there is no guarantee, right? So as we look into the market, so what are we going to set up into these markets? What kind of positions do we want to put up? Well, again, right now, the markets are painfully slow. Okay, this is one of the biggest issues that I have right now is that, oops, wrong one. I want that one. Is the markets are painfully slow. Okay, the volume is pathetic. Okay, and even in a fairly solid down day, look at this volume. It's barely crawling. Okay, well, we are in August. These are the dog days of summer. So the likelihood of a major new move coming now is not very high. Okay. Again, we're only talking about, we can use the past to use as a guide to the future, not to an automatic. It doesn't mean that it'll never happen, but what's happening now in these markets is there's a lot of things that are setting up what the future is going to bring. Now, I actually go back to 1987. I actually go back to 1980 on the trading floor. But in 1987, there was a lot of work that was done in the charts in August of 87. Now, the market didn't collapse, obviously, until October 19th. However, the action started to turn ugly in August, okay? And it just kind of chirped back and forth, but it was uglier. And then suddenly, the week before, nobody talks about this. Everybody talks only about the big meltdown on the 19th. The week before, the markets were extremely ugly going into that weekend. And of course, we know that in those days, because there was no Sunday night trading, there was no way to resolve these markets, okay, yourself or get out of trouble. You had to wait till Monday morning. You didn't have the access to a computer by yourself to put your own trade. You had to call your broker. Well, everybody panicked, of course, because as you let things fester over the weekend, you decided that it was time to sell because you saw the action from the week before. So what we're seeing now is we're seeing some damage in the markets. And again, I'm not telling you that this is the next collapse, okay, that we're going to get to the next collapse. I personally do believe that these markets are going to sell off 50 to 70% at some point, but that doesn't mean that point is tomorrow or in 6 months or in a year. Okay. I firmly expect to see a repeat or a similar trade to 2008, to 2001, to 1987, and other big sell-offs in the past. Okay, there is no doubt in my mind that it is coming. But again, I am not, I just disclosed my positions, which tells you that even though that's what I think, I have not put positions on this to satisfy my opinion. Why? Because I don't trade my opinion. I trade the price. I trade price action. And this is what we're doing. In fact, we traded this morning, okay, with my members, okay? And we made money shorting crude, believe it or not, earlier. And okay, and we made money buying the 10-year notes earlier this morning, okay? And look at them now. They're both going the other way. So the price action is what dictates what my next trade is going to be, not my opinion. You know, news and your opinion are worth, well, you know, it's that thing that you sit on. That's what we all got one, right? That's what opinions are worth in news, which is why I tell you, don't watch the news. Okay, you want to watch news for entertainment? Hey, great. You want to watch the news for some reality? You're not going to be able to trade up the news. Remember, the news that you get, by the time you get it, you're probably the 10 millionth person to know what's going on. And we have a lot of news coming this week. There's CPI, which should be a pretty big number, a pretty big reaction. I don't know which way, but you already know that the big firms are already starting to price in what they think is going to happen. Okay. But when you hear the announcement with the number, if it's a bad number and the market starts to go down, don't chase them down. There's a higher probability that they will bounce from that big sell-off instead of continue to go straight down. You cannot panic. There's an old commercial, if you're old enough to remember, never let them see you sweat. Okay. Don't get nervous. Know that, for example, here, where's my XBI, right? I mean, if I had XBI, if I owned it, which I didn't, okay, I do own it now, okay, but if I owned it, I wouldn't get nervous. I would be looking for just what I did to buy it, okay? Don't chase the markets down or chase them up. The FOMO, fear of missing out trade, is a loser. It's always a loser, okay? If you think that you can make it a winner, you're wrong, okay? Again, this is where you need to wrap your head around market conditions, price action. And the fact of the matter is, okay, if I wasn't doing this show with you guys right now, okay, I'd be on the golf course right now. I wouldn't be here because there is no real trade. There is no real activity in the market. Okay. I have positions on that I'm certainly capable of rolling them and putting them forward. I've got on a number of double diagonals. I've got a number of calendars on. Why? Because those are all limited risk. Okay. Good luck. They're all limited risk. Okay. They're all unlimited profit potential. Okay. But I don't have to worry about it. Okay. And I can do my rolls forward. Okay. And still be in the same position while collecting premium, reducing my overall risk, which is all I'm trying to do. Right. I'm trying to bring myself into a position to bring the risk down, bring the potential profit possibility higher, but also know that right now there is not really truly enough price action anywhere for me to make any real money. And as a former floor trader, when we had a real advantage trading paper, okay, which is the order flow, because we were the computers back in when I traded, from 1980 until 2010, computers started to come into the markets around 95 or so. But when we were on the floor, we were the go-between. We were the computer that made the market, that put together the bid offer spread. Okay. And of course, then I had an edge. Now I don't have that same edge. I don't get to buy the bid. I don't get to sell the offer, because when I sell, I'm selling the bid. I might pretend that I sold the offer, but I'm really selling the bid. And when I buy, I might pretend I bought the bid, but I'm really buying the offer. I mean, that's why the environment in which we trade is different than the environment as a actual floor trader. So I want to put myself in positions that I can continue to roll forward, okay, which I use like the 0 DTEs, okay, to roll forward. And every day I'm buying back something that I sold and I'm selling for the next day, okay? Or every week in a regular calendar, I'm buying back what I sold and I'm selling it for the next week. And I'm going out and with these conditions of low volatility, which we are still in, I can go out farther with my dated options because there's opportunity to go out farther. And again, it just depends on what you're looking at and what you want to trade. But my recommendation to any of you, if you are trading, okay, if you are, I'm just putting on a trade. If you are trading, okay, anything, make sure you try to trade things that have weekly options. Okay, try things that have weekly options. Why weekly options? Because there's more liquidity. Okay, but then make sure that you do have liquidity as well. Okay, there's a question on those diagonals. Do you dump the long calls, the back month ones, if the premium goes? No. Again, remember, this is like, and you're new, so I'm teaching you at the same time, right? You and I talked on Sunday. Okay, you're going to what you read in my book, which is all accurate. Okay, but what you read is something that I'm not managing actively with you, was a way to teach. Okay, now I will actually, when a position goes in my favor, if I'm using a double diagonal, which is what you're using with me, okay, if an option goes up to 80 deltas from the 50, I will then sell the 80 and rebuy a 50. Okay. So I will end up with positions that are split because I've captured some of the profit as it's going up or as it's going down. Does that make sense, my friend? I know it's harder. Obviously, I'm in a live YouTube channel talking about this, but does that make sense? If not, I'll try a better way to explain it while we're here, and I can show it to you. If not, I'll also explain it to you on Saturday. Email me the same question if I didn't answer it for you here. Okay, but you got to let me know if you understand it, so I can help and make sure. Obviously, I can't see your face, so I don't know if you're glazed over when I say something like that, because I know some of this stuff, as I told you, is counterintuitive to what I wrote. But what I wrote was before there, it was 10 years ago, before there was liquid weekly options. Number one, okay, that's okay. That's not a problem. I just need to know. So do me a favor, send me the question, email it to me because you have my email, and I will cover it on Saturday morning when I have more time to go through it piece by piece. Does that make sense? Okay, that's what I do, right? You haven't been around long enough to know how I educate, but that's what I do. You send me an email, and I can piece it together and take my time with it versus trying to do it here now. Okay. All right. Anyway, so I don't trade anything unless it's got weekly options. Okay. The only things that I trade that do not have options or do not have weekly options are my mutual funds, which, being self-employed and having a SEP IRA, I have to trade mutual funds. Okay. So I also hedge that stuff. Okay. So I want to make sure that I know A, what the mutual fund represents, and then B, how to hedge that, because I don't ever sell. Okay. In my investments there, I hold a stock until forever. Okay. The only time I get rid of some of my stocks is if something fundamentally changes in a stock. Like, for example, in General Electric, I didn't own GE, but I would have sold it once the information changed. Planeteer or Palantir, I did own that. I didn't like the way that it changed. I didn't like the fundamentals that it changed, so I got rid of it. Now, I'm not a fundamental trader, but if you're buying for the future, for the next 20 years, then you want to make sure that you have companies that are strong, that are going to be there in 20 years. Could you cover a little bit more on how you use puts to mitigate the risk of your synthetic stock position? Well, I create a back ratio spread. I mean, if I'm, I have a hedging class that I do, but for example, if I owned a 1,000, well, here, we'll use 100 shares. If I owned 100 shares of the SPY or a SPY equivalent, okay, right now I'd actually be going out to December, okay, because I use the triple witching legs, okay, because that's where the most liquidity is. And believe it or not, even though the premium is $14 or whatever it is out here, it is cheaper than doing it weekly, monthly, or any other period, because the sum total of the option gets more expensive when you keep adding them together, because the sum total of the weekly is greater than the sum total of the monthly, and the sum total of the monthly is greater than the sum total of the quarterly. So we use the triple witching cycle. So right now, if I own, let's say 100 shares of Spiders, I would be putting on the 447, 445 back ratio spread. Okay. So now I know that my protection comes in where? Okay. My true protection comes in at, it's $13. Let's say we'll use 13 round numbers, $13 subtracted from which? 445, which means my true protection comes in at 432. And there's one other part of the equation that I have to account for. Okay. And that is the spread risk I have. So I have a $2 spread risk on one contract. So my real protection comes in at 430. Okay. So 430, that's only about 3.5% risk on 100 shares of the Spiders. So that's part of the trade. Now there's a lot more to what I do, but that's a quick base. I think that answers your question. Okay. And now this 1/2 back ratio will be rolled down. Okay. If the stock goes down 3%, which is the numbers that I use, then I'll roll this down. So I would then roll this down to the 430, 428, capture the profit take the profit and buy more stock, okay, and then move forward from there, okay? And that's kind of what I'm going to do when I use this, because the objective is, if we understand and we know that the markets go up 8.5% year over year. They don't go up every year, but over the average since 1900 is 8.5% year over year. The average since 1950 is 10% year over year. Okay. Now that means there's gonna be some down years, but if I'm protecting, all I'm doing is accumulating more stock as the markets go down, which if I'm assuming that I'm correct that they're going to recover, then I'm going to make a lot of money. Okay. Use delta. You use delta to manage the risk of premium. I think you're saying. No, I don't use delta to manage the risk. I only talk about delta because that's just at the money, right? I don't really care about delta. I care about at the money. That is where the highest probability of success is by using the at the money option, okay? Because it's the only true 50-50 coin flip trade. But I do use delta to roll out and capture some profit if I'm in a trade that I'm long, for example, and the call now goes from, it goes from here. Well, if I have the call in the short term, which is, in August 11th, and my call, the 50 delta call is the 446. Well, if the 446 goes up to like the 452, that'll take it to about 80 deltas today. Okay. I'm going to take that and I'm going to roll it back to the new $50 50 delta option. Okay. I'm going to take profit off the table, but stay in the same position that I was in to begin with. Okay. I want to be long, but I also want to make sure that I'm able to take some money off the table. Does that make sense? Okay. If it doesn't make sense, let me know. I'll do the best I can to explain, how it all works for you. Okay. But that's kind of what we're always, looking at, and the job that we're always trying to do. Okay. We're always trying to make sure that we can get some profit off. Okay. But that's how you kind of use the synthetic. Okay. And again, these are just, obviously you'll be with me. If you come every Tuesday and Thursday, you'll get a lot more, right? That's our education. That's what I do. I like to educate anyways. Okay. And also you should probably remember to subscribe. Right below there is a subscribe button. Subscribe to the Hub channel because there's other great shows here as well. Okay. So make sure you become a member. It's free. And why not? And besides, if you're not using Tradier, you should go see a doctor anyways at $10 a month. Okay. I mean, it saves me $100,000 a year in commission with as much as I trade. So, but anyway, so back to the markets. So when we look, again, the markets, again, they're blasé, they're slow. There's not much going on. I mean, it's really, as they say in English, it sucks. Okay. This is horrible trade. This is horrible action. Right now, we're just going down. Okay. And again, but really the bigger picture is, it doesn't look so bad yet. So the real key is going to be, where's the close of some of these things today? Do they close below support? Then they would become potential sellers. Hold on. I got an ice cream stuck in my mouth. Bad habit. So again, right now, the overall price action is weak. Okay, there's not enough true action to create any real great opportunities in the trading market. Not that you can't put on positions for more of a long term. Again, there's what are you trying to accomplish? Are you going to try to day trade? This is a horrible market to day trade. Okay, I'm telling you that it's a horrible market to day trade. These are the kind of days that when I was on the trading floor, okay, we went to play golf. Okay. So in the meantime, if you're putting on positions, well, yeah, then you're looking for chart points on whatever you're looking for. Give me any stock you're looking at a position, I'll give you what I would do. But again, you're looking for chart points, and then you're deciding on what type of position that you want to create that can limit your risk, not limit your reward, and give you all the opportunity in the world, and at least put yourself in the highest position of probability to be successful with that trade. Okay. That is something that you have to always keep in mind, is how do I create a better edge for myself? how do I put myself in a better position to make sure that I have the opportunity to make money? Now, again, remember, no matter how good you are, every trade is not going to be a winner. Okay. But if you're always setting yourself up and you're managing the risk side of the trade, right? That's the side we're concerned about. Profits will come. But if you're not taking care of the risk, and if you're opening yourself up or exposing yourself to too much risk, well, then what are you doing? Then you're really just opening yourself up to trouble. And there is no reason for you to expose yourself into trouble, because at the end of the day, okay, this is a business that is a grind. It is a long-term grind every day, okay? Every position is a grinded out position. You'll catch the occasional home run, but you better make sure that you don't strike out too many times, okay? It's a piecemeal, pick up some money, pick up some money, pick up some credit, and be prepared for the much bigger move. While also recognizing that if you expose yourself too much at any one given time and it doesn't work out for you, you're too over leveraged, then you're going to go broke, okay? And just because you have leverage in options, or just because you have leverage in futures, doesn't mean that you take full advantage of all the leverage, okay? Leverage is a great tool, but it's also a dangerous tool, okay? And unfortunately, too many of us get too far over leveraged, and over leverage is phenomenal if you're right, okay? But let's assume that we're not going to be right. Okay? Let's assume that we're going to be wrong. Well, suddenly too much leverage takes you out of business, okay? Your number one job as a trader is to protect your capital. That is your first job, is to protect your ass, protect your money. If you don't protect that, you got no shot to ever be truly successful. Yeah, you'll have some big days, but you'll have some big days the other way too. It doesn't matter how much money that you have, okay? Always start with a minimal amount to feel the thrill of victory, the agony of defeat, and how much capital you're actually using at one given time, which is why that nobody should ever use more than 2 times leverage to start with, because you can go a lot bigger than that. But if you start out too big, guess what happens? Okay, you get trapped early, or you get trapped late, and you're out of money, and then you're wondering what truck just ran over you. Okay, remember, your business, your job is to grind it out. Your job is to grow your account organically, not by not by putting in $1 million. You want to get to $1 million, you start with whatever you start with, and you increase your size as you have successful trades. Okay, you increase in proportion to the amount of money that you're trading with, not the amount that you're going to add to it, but the amount you're trading with. Doesn't it sound like more fun to grow organically and make money than put it all in at once and put yourself at major risk with no turning back if you blow it? Okay. Again, this is a thing that has been around in the trading world forever, and I've seen, I don't know, on the trading floor, I saw thousands of guys come and go, okay, that did not understand the very principles that I'm explaining to you right now, okay? So you must remember that the risk management tool is the number one thing that you have to do before any successful trade, because any jackass can get lucky on a score, but that same person will more than likely blow the score and end up busted when it's all said and done, okay? Now, again, I can only tell you from experience. I've watched this. I've been doing this myself for 44 years. It's the only job I've had since I was 21 years old, okay? And it's always been for my own money. I don't trade anybody else's money. I trade my money, okay? That's how I make my living. I'm the only guy on TV that is an independent trader that doesn't trade anybody else's money. So you want to look at the markets. You want to recognize the activity, and there is none. This becomes the bigger issue, is the lack of activity. So what do I do here? Well, either I'm looking, I'm going to share it back with you. Okay. Either I'm looking for a particular stock or a particular index that I want to buy at a particular price. Okay. If that price comes, I'm going to set my trade up, which I could actually set that trade up ahead of time, knowing that it's there, or I'm going to do nothing and I'm going to wait for some more activity. And again, if you're looking for a specific spot, then hey, I got no problem. If you say, you know what, I was dying to buy Apple at 177. Okay, hey, no problem. Buy it at 177. Set your position up based on it. I have no problem with it because you're going to carry that. You're going to hold that position. Okay. But just to trade Apple at 177, just to trade it, again, I wasn't looking for it. What do I need to get involved for? That's what you want to remember. Okay. Putting yourself in positions of risk in markets that aren't active is virtually almost impossible to make any money. And the trading becomes brutal over time. Okay. Are there any questions from anybody before I kiss you all goodbye and sign off for my for this Tuesday? Okay. Anybody? I'll give you a couple seconds. I know you're delayed a little bit behind me, so again, I'm kind of watching. So I know the lag time is probably about 10 seconds or so. That's so they can beat me out when I have a big mouth and start mouthing off. But you know, at the end of the day, okay, remember, risk management, watch the market action, put yourself in a position of success. Okay. And we're going to work on that. That's going to be part of the theme of the show as we do this all the time. Remember, subscribe on the bottom, okay, so you can get notice when I'm going live. I am going live usually, most of the time, every Tuesday and Thursday at 11 Eastern. This week, if I do, it'll be taped. But as a rule, I'll be live Tuesday and Thursday every week. I'm here to help you, educate you, and take your questions. In the meantime, I'm going to call it a day. Max and Ruben, that's it. Have a great day, everybody. Remember to subscribe. I'll see you on Thursday. Have a great day, everybody. We'll see you later.